Yes, headroom. Remember Max Headroom, Attila. Welcome to another broadcast of Real Turkey channel. This is your host presenting, Attila Yeşilara. Dear audience, spectators, I read your comments religiously. I learn a lot from them. Try to improve myself. Sometimes I laugh very, very hard because I think the comments are sometimes more interesting than the content of the video. And there's a lot of hate speech, which, how social media goes nowadays. But among those which seriously want me to take some kind of action, over the last 2, 3 videos, I've seen comments from different individuals, I believe, that I should talk about financial assets, crypto coins, emerging markets, etc., etc. Okay, I said, so I'm going to do a two-part video. In the first, I'm going to talk about Turkish financial assets. That's the lira, actually dollar TL exchange rate, Eurobonds, CDSs, Turkish lira denominated bonds, and of course stocks or equities. And Lord Almighty permitting, if I'm still alive, in a few days, I want to express my opinions about emerging markets. Before I start explaining to you my thoughts on the subject, it's very important that you understand this is not investment advice. I'm not an investment advisor. I'm a research person who has worked in the financial markets for 30 years. So I'm merely expressing my personal and educated opinion on the direction of certain assets and markets. If you take any action on the contents of this video, well, you are more stupid than I thought. Don't invest. Just watch. Okay. I have even done a cover this time, really, just feeling very energetic. That's because oranges. I mean, if you think I'm very young for an 80-year-old, that's because I eat oranges every day and use the peels for skin massage. Okay, well, here's the cover. We're talking about financial assets. They are cheap, but risky. And it is up to the professional investor to weigh whether the value is worth the risk you are taking. But let's start by defining the scope of the content. I'm going to talk mainly about Turkish lira, Eurobonds, equities, or stocks, depending on which country you're from, and TL denominated bonds. These are considered cheap. And then I'm going to define what cheap is, because value, as in beauty, is in the eye of the beholder. And then, of course, we're going to move on about why they are cheap and whether they can ever recover their value in the short term. Well, value is a relative concept. What's valuable to you may be completely worthless to me, and vice versa. But there are certain conventions, and two of those is to compare the price of the assets today with the average value of the same assets over the, say, 10, 20 years. If they are way above their long-term average values, then you have to answer the question of whether something in the economy or politics has changed to increase the inherent valuation of these assets. If not, then obviously you conclude that it is expensive. This is the first method. The second method is to compare an asset class in Turkey, for instance, stocks, with stocks in other emerging markets, say Russia, South African Republic, I don't know, India, or better, to compare the price earnings ratio. You can use other ratios as well, such as the EBITDA or price book value, or sales to market value, etc. But to take a valuation metric and compare it to EM averages. And if there's a significant deviation in the direction of one asset class being much cheaper than the EM average or vice versa, again, you ask the question of whether that discount or premium is warranted, or do we see any events or developments in the horizon that would validate the valuation differentials. If not, then assets are cheap or expensive, then they ought to be bought or sold. Now, Turkish assets, all of them, except the Turkish lira, because of the last month's rally, are cheap. When I talk about the inherent value of the Turkish lira, I look at IMF and International Institute for Finance valuations. Some of them are subscription basis, so I can't read their reports each month, but from the Twitter feeds, I understand that the fair value, the intrinsic value of the dollar TL is 7.5. As of today, dollar TL was around 7, maybe even slightly lower. So Turkish lira is slightly overvalued. But you have to remember that these are ballpark figures. I mean, if IMF says the true value of dollar TL is 750 and the pair is currently trading at 5, I would say, aha, to me, this is too expensive. And look for reasons whether this valuation differential ought to exist or not. But, financial markets always undershoot and overshoot. So the difference between 750 and 7 is not that much. But clearly, if the lira appreciates further versus the dollar or the euro, then I would be concerned, because I don't, as I explained in the rest of this video, I really don't see a future world where economic and political conditions would improve to validate this valuation of the Turkish lira versus major currencies. For stocks, it's much cheaper, it's much easier. Currently, on expected earnings for the end of 2021, the premier Turkish equity index, BIST 100, trades at roughly 10. I say roughly because obviously you have to look around a wide range of brokerage estimates and take the consensus, but only Bloomberg has the consensus and they sell it. So I'm going to say roughly 10. And last time I looked, MSCI EM equity index was trading around 15. So, Turkey ought to get some discount because of its higher political risks and its lower growth potential vis-a-vis the average of developing nations. But that chasm between Turkey's expected price earnings ratio and the EM average seems excessive to me. So there is some potential for Turkish equities to appreciate. How much potential, you may wonder? Once again, not my original research. I'm quoting respectable brokerage house research. The Turkish stock exchange could rally by about 20% until the end of the year to bring valuations in line to EM averages, which to me sounds reasonable. As far as Turkish lira denominated bonds, there are various ways you look at the value, but what I consider the fair value is the yield versus inflation. Currently, the compounded annual yield on the 10-year TL denominated bond is about 13%, whereas the headline inflation is 15%. And I think year-end inflation forecast by the central bank tendency survey is something like 11.5. So either you would be buying Turkish bonds at a negative real yield or at a very meager positive yield. And given the volatility of the bond prices, the volatility of the currency, and political risks, on that basis, Turkish lira bonds are expensive. But remember what I said at the beginning of this video. There are two ways to value assets. One, based on their past histories. Two, based on comparisons to other nations. And in comparison to India, Brazil, South Africa, United States, Turkish bonds are extremely cheap. That's what we call carry trade arbitrage. They are cheap in the sense that you can borrow money in dollars for Turkey's credit risk, hedge your Turkish risk, Turkish lira risk or credit risk by buying a CDS, which costs something like 300 basis points for every $5 million. And then invest the remainder of your funds into a TL denominated bond. If there's a positive yield, then that bond is cheap. And on that basis, Turkish bonds are cheap. Looking at Eurobonds, once again, you can look at Turkey's credit risk. And to me, Turkey does face a default risk that is really not captured in a CDS price of 300 basis points. I think Turkish budget deficits are likely to rise over the years because of the low Turkish growth rate. The composition of domestic debt is now heavily skewed towards FX-denominated debt. And finally, Turkey has many contingent liabilities, such as the assurances of repayment given to the concession holders on mega projects. That's a different set of video, but considering the risks, I wouldn't necessarily say Turkish Eurobonds are cheap. But going back to the other valuation, you can also measure the value of a sovereign Eurobond compared to the, you can use JP Morgan EMBI or you can use Barclays index, compared to the yield on those indices for equivalent credit rating countries. That is, Turkey has a credit rating on average that's 4 notches below investment grade, and its bonds trade at X% per annum yield. You look at other countries' Eurobonds with the same credit risk, and if Turkish Eurobonds are trading at a higher yield, then they are cheap. Along those considerations, I think Turkish Eurobonds are fairly valued to cheap. In essence, if we leave aside the recent rally in Turkish lira, which has obviously affected the valuations of other asset classes, Turkish assets are, relatively speaking, cheap. In particular, they are cheap in an environment where EM risk appetite is rampant, almost bubbly, and investors are buying junk-rated bonds across Asia, Latin America, and Eastern Europe. So why not Turkey? I mean, given the strength of the appetite, Turkish assets are certainly not receiving enough consideration. And the main reason for that is politics. Under the former economy czar, Mr. Berat Albayrak, Turkey had really screwy economic policies. I mean, they didn't make sense to anyone, whether you're Keynesian, monetarist, postmodern, they just didn't make sense. I mean, they were extremely arbitrary and completely myopic. So that irritated a lot of investors and they kept out. But I think in November, if my memory doesn't fool me, Mr. Albayrak was replaced with the duo of Mr. Lutfi Elvan and Mr. Naci Agbal, the former, the new economy czar, the latter, the central bank head. And even though I wouldn't say Turkish economic policy is optimized at this point, there's still, a lot of silly stuff going on. But it is by light years better than what we used to have. And that elicited a rally. So this is the situation. Let's look at our cover and address the key question here. Can the rally continue? Obviously, we live in a world where black swans dominate. Anything strange can happen. But there are two key criteria here. A, and that's true for all EM assets, will the risk appetite for EM endure? Two, the fate of Turkish assets will be determined much less by economic fundamentals than political considerations. In particular, Turkey's ongoing disputes with the United States and EU, which may at the end trigger sanctions. So let's try to answer these questions. The first question, whether the EM risk appetite will endure throughout the year, will only be answered in May. Currently, all EM assets, and even assets in developed economies, are priced on the following factors. The pandemic is subsiding, vaccines will end it. By summer, the world economy will start the road to full recovery, which will be completed in 6 months, say at the end of 2021. Two, led by Fed, major central banks would remain extremely generous in terms of money printing or bond buying. So even though the economy is recovering and there's some kind of inflation, monetary easing will not end until the year 2022. And finally, of course, the onset assumption, geopolitical risks are there. We can't avoid them, but they will not escalate as they used to under Trump, who used to wake up one morning and declare sanctions on anyone, including Albania and Macedonia. You may not even know where those countries are. Anyhow, these are the unwritten assumptions. I question them, and I'm going to do a video on them. The next one is going to be about emerging assets. I don't think we're going to be able to lick this pandemic fully before the end of 2021. That's because vaccination campaigns are going much more slower than people had anticipated, and two, because the virus is throwing out new variants each day, some of which may be vaccine resistant. I'm not pessimistic. I'm sure modern pharmaceutical industry will find a solution to those mutant viruses, but at the end, to expect a full recovery by the end of 2021 is excessively optimistic, if you ask my opinion. And of course, secondly, I expect, even though Biden is a much more moderate and calm-headed president vis-a-vis Trump, I expect political tensions between the United States, Russia, and China to escalate again. They may take different forms, but at the end, they will hurt company profits and they will lead to dislocations in the value chain or in the way foreign direct investment flows. So that's my first concern. Even at a time when there is a torrent of hot money flowing into emerging markets, Turkey didn't really get much. It got some. It's better than money fleeing your country. But compared to our size and to our potential, we receive a pittance. So if EM risk appetite falls, it stands to reason that unless we perform miracles in terms of economic management, Turkey will face hot money outflows again, and that will end all the rallies. That I expect around May. If I'm wrong, then obviously Turkish rallies will continue. Secondly, March is very critical because in March I expect Mr. Biden and EU to tell Turkey what they expect the country to do. I expect them to say, well, get rid of your S-400 Russian-made anti-missile batteries, improve your human rights, release your political prisoners, be more reasonable in terms of the Eastern Mediterranean and Cyprus disputes. I am not saying the West is right in demanding these things from Turkey. That's a political video I will do later. But that's what they will demand. And if Turkey doesn't accept these demands, or if there is not a negotiation, I'm really sorry, that ends successfully, if you do 10 videos a day, this is what happens. Too much air comes in and not enough thought comes out, so you start hiccuping. If you believe that Turkey will be able to negotiate its differences with the West successfully, thus averting sanctions, then Turkish assets are definitely cheap because the political risk profile is going to stay low throughout the year, and investing into Turkish assets will make sense until they reach fair value. This is not my view. I expect Mr. Erdogan to resist Western demands for right or wrong reasons. We're talking markets, not politics. And I expect Turkey to experience another currency shock. A currency shock is where, for political reasons, economic reasons, reasons of natural calamities, a currency depreciates suddenly and unstoppably, say about 20% at the minimum. And only then the balance of payments problems, bottlenecks created by that currency shock may bring Erdogan to the negotiating table, and he may then compromise. To make a long story short, there is a huge hurdle to further rallies in Turkish assets in March, which is the political disputes. And unless one has a very firm view that Mr. Erdogan would successfully negotiate these differences away without sanctions, then Turkish assets are cheap, and they are rightfully so. I want to thank you for watching another Real Turkey channel video. Our audience is small, but I receive very high quality comments, which shows me that people who are interested in the affairs of the world are watching these videos. If you like them, share them, spread them to people who may do business with Turkey. This is Atilla Yeşilada saying goodbye from Istanbul.